Okay, fire away.
All right. Yeah. Hello, everyone. Welcome to Wall Street Reporter. Senior editor Andrew Packer here, back at it again, looking at some of the big macro trends that are going on right now. But let's face it, this past week, we've all been watching these retail stocks just kind of go to the moon and back. And there's been a lot of crazy things that have been going on, not just even with these stocks, but a lot of unrelated stocks as hedge funds have had to adjust positions, as brokerages have had to kind of shut down trading in a number of names. And that's to say nothing of the options market, where these huge moves can create even bigger moves kind of behind the scenes that can potentially create a lot of danger. So to address kind of these issues and what's going on, today we've got with us Professor Mark Gunther. He's the professor of financial practice at Rutgers Business School. He's the author of The Options Edge. His website is theoptionsedge.com. Obviously, we want to know what's going on with the stock market and how that impacts the options market. So Mark, thanks for joining us.
Oh, absolutely. And thank you for the invitation. I always enjoy these, especially when there's a little Q&A, that's off the cuff that I don't even expect. It keeps me on my toes.
Right. Our viewers are definitely going to have, I think, some questions that, neither of us could have necessarily thought of. But let's start with your thoughts on GameStop. It's what's on everyone's mind. There's been this massive rally to, $500 a share in intraday trading from $5 less than a year ago. And now we're around $100 today, kind of intraday trading. That's 80% off the peak. Right. But I mean, it's still $100 for a company that on a fundamental level is not worth anywhere near that. But if you believe the short squeeze play hasn't finished playing out yet, it seems like there could be some upside there. So what do you see going on?
Well, I see this as being a really exciting confluence of events. One is the whole idea about the crowdsourcing of ideas and social media getting people together and sharing their ideas. When I was a derivative strategist over at Bank of America Securities and a few other firms, we would have these hedge fund dinners where you'd invite in 25 of your best customers for a huge round table, have a little dinner, a little libation, and talk about your best ideas. This would give people ideas either to get on board what other people are doing or maybe look the other way. So some people might say, hey, I've got a huge short in XYZ, or thinking about a huge short in XYZ. Well, there might be some other hedge funds that said, we don't think that story is so bad. Maybe we'll let them get their position fully expressed, and then maybe we'll come in later and start to buy the stock. So these little battles between the bulls and the bears and the short sellers have gone on in the institutional space. And so this is the first time we saw, the thousands, I would guess, of people, if not tens of thousands, buying 100 shares here, 200 shares there. Maybe down when it was started out at $20. Maybe that 1,000 or 2,000 shares. Maybe the people took bigger positions. So what I thought was interesting, I went back and reviewed the tapes, if you will, and the share price kind of bottomed in the middle of last year, and then it sort of had this little upward momentum that went from the single digits up to about 20, and then that's when the fireworks went off, and the stock really took off. And you could understand why. If you're a hedge fund and you're short, you're short the stock, let's say at $20, it goes to 40. You've just lost all the money that you've put aside for that position. If you've quote unquote fully fund your short position. A lot of firms will do far less than that, of course, because they can use margin to do so. So the first bit, I think, that was taking off, that took the stock from about 20 up to about, it ran to like 150, and then it came off and went down to about 80. On that day, this was about Wednesday, I think, of last week, maybe it was Thursday, I remember looking at the open interest on the options. Stocks trading at about 80, and there was 20,200 strike calls outstanding for February's expiration. And I think, and there was in between that 80 and 200, there was like 3,000, 4,000 at each of the different strikes. So
Right.
there was quite a bit of upside buying in the options. But I think it's that 20,000 contracts where we really got the gamma effect kick in for that stock, because at $80 you would buy a market maker would sell these options to a customer, and for every option they might short 5 shares of stock to hedge. So that's called an O5 delta. So then stock goes up a little bit, and now they need 10 shares of stock to hedge. So then they step in the market to buy their 10 shares. And so they're acting to push the stock in a direction they don't really want it to go. This is the nature of the gamma spike. So then what was interesting is overnight the stock went from 80 to, I think, what was it, about 200.
Right.
And so on that day, when they opened up trading, market makers needed, for every option, they needed 50 shares, but they only had 4 or 5. So they had to step in and buy a lot of stock. They had to, I'm sorry about that. My wife just turned on the printer with a remote print. It was about to make a lot of noise. That first hour of trading that really ran the stock up even more into 250, 280, and so on. And so by this point, anybody that in the market making arena that had sold options to capture this huge implied volatility and huge time premium. The time premium on the 200 strike options when the stock was at 80 was something like $10, unheard of level. So those that use option pricing models would price that out at something like a 350 or 400 implied volatility. That's a number I'd never seen in my entire career. And I think a lot of people that sold those thought, hey, this is going to be some easy money. We're going to buy this, we're going to hedge it. And these things are going to time decay so fast, we're going to clean up. Unfortunately, that wasn't the case for the folks that did that. So I think market makers got hit. I also think there were just other retail players in the marketplace that probably like to sell out of the money options to capture premium with the hopes that they expire worthless and kind of move on. So it was really an exciting few days. Is it going to continue? I saw that and I haven't been able to verify the numbers, that the short interest is down, well down, like maybe down to 40 or 50%. And it's one of the charts that I saw that somebody posted up on Twitter that over this last weekend, it just collapsed. So if that's the case, we shouldn't expect too much fireworks anymore. And this is kind of how I thought it would come to an end. And this is a way a lot of short squeezes come to the end, is those entities that are getting squeezed, when they finally give up the ghost, because they fight it all the way up. And when they finally say, we just can't take anymore, the pain is too much, and they liquidate, that's usually the event that that last sort of uneconomic buying, because you're not buying because you want to, you're buying just to get out and to stop the bleeding.
Right.
That the whole thing comes to an end. So I have a feeling that's what's happening now. Will there be another go? Well, we're kind of in a new world, because how is this crowd of traders that are sharing ideas, going to trade with us? I was getting a little concerned on their part for them when they started to talk about silver and perhaps squeezing silver. There's only so much firepower they have, right? And so if they start saying, well, we're going to squeeze this and squeeze that, they're spreading their capital maybe
It's
a
not
little bit too
concentrated
thin.
anymore. Right.
So, so I had some concern that there was like, hey, we had such a easy time with that. And there are other names, like one of the names that we had recommended on our website in an auction position. We recommended what's called a risk reversal, and a risk reversal is sort of like a stock replacement strategy. You buy an out of the money call, and you pay for it by selling an out of the money put. So if the stock falls a little bit, you don't really lose any money. Stock needs to rally pretty good amount, and then you really start to make a lot of money. And generally, you don't have to put up much money to put on the trade. Sometimes you even generate a credit when you do that. And that was in Discovery Channel, which has about a 45% short interest. And this was a name that we liked because I thought the company was making very good money. They have a fair amount of debt because of acquisitions. So the professionals kind of say, we don't like that. I'm not a person that is in this environment where the Fed wants to hold interest rates down to ridiculously low levels. It pays for companies to have a lot of debt on their books, and it increases their returns on equity substantially. And if you can use that money to buy really good franchises, which what they did, that's a good thing. So that stock went from the almost doubled. And if you look at a chart from a couple of days ago, it was like a mini GameStop. It went straight up, something like $15 or $20, and I'll take that any day of the week on a $25 or $30 stock. So that was something that we were in, and then let it go. I'm always one when I trade to leave a little on the table for the next guy. I don't want to get the last dollar or try to trade for the last dollar. On the upside, I'd rather sell to somebody who gets a little bit and hopefully he gets out too with a profit. It's kind of the way I've always traded as a professional trader. That it's sort of been my underlying philosophy.
Right. Now I know what's going on with GameStop. A couple of people on the Wall Street Bets subreddit have mentioned that there's a bit of a sort of a short ladder kind of going on where the volume has really evaporated in the last few days.
Right.
A lot of people who have bought their shares are holding. You have people posting about how they're just going to hold it to zero if it goes to zero because they kind of started with nothing in this anyway. And if they end up making a lot, great. If it ends up going away, like no harm, no foul, they're going to get another bailout soon anyway, some more stimulus. But, some of these people are just saying, like, look what's happening here. This very light volume, this could just be funds selling back and forth to each other kind of at lower and lower bids, especially since Robinhood and a lot of the other brokerages limited the buying power by limiting how many shares people could buy.
Oh, yeah. And I think that was a very bad thing. It's an awful precedent, and I think it damages their franchise, to be honest, because they're Robinhood, right? They're there to help the little guy and take money from the king. So in doing so, and I, in the interviews that I've seen afterwards, it had to, the CEO said it had to do with the need for additional capital, and they couldn't trade. Because, most people, you buy a stock, you sell it stock, you see it in your account, it's not in your account anymore. But there's 2 days between when you do your trade and it settles. And so the broker has to have money put away in case something bad happens between the trade date and the settlement. And so they talked about how we kind of ran out of money to put up for that keep our business going. It seemed a bit extreme that only you could either not trade or you could trade 1 or 2 or 3 shares.
Right. That's arbitrary.
So I think that PR is just a little tough to accept at this time. And I think if they were more transparent right up and just say, hey, we have capital limits and this is causing us to, and we have to do this, they would have been better off as opposed to just saying, Yep, can't trade anymore. That was fun while it lasted, but
Right.
that's not cool at all.
Yeah,
Not
there's
cool
rules
at
for
all.
hedge funds and there's rules for your retail traders, and
Yes,
stop trying to play by their game. And
yes,
that's the impression they've
yeah,
given.
and
And it's probably true, just maybe not consciously.
yes, and people are always a little skeptical about what's gone on because look at you lived through the financial crisis, and little guy didn't get bailed out in the financial crisis, but a lot of banks got a lot of big checks, and a lot of people lost their houses and stuff like that. So there's reason, to be cynical, right? Um, when you see that maybe the system is not as fair as you would like it to be, or at least to hope it to be, and so I think they damaged their franchise. I don't think they damaged it beyond repair, but they've got some real work to do now to get their customers back. I think their biggest advantage in that space is like, well, okay, if you leave them, who are you going to? So we might not like you, but compared to what? Are you going to like Schwab better? Are you going to like TD better? Are you going to like some of these other brokerages better? I don't know, because I think the people that are at Robinhood started out saying I prefer not to use their services. I like what Robinhood's
Right.
what's trying to do. So I think they have every opportunity to fix themselves, but they have their work cut out.
I mean, yeah, I'm not 100% convinced the short squeeze is over. It looks like the
No.
short interest is still pretty high, but I feel like the gamma squeeze part of it, where people are just buying the most out of the money call options they can and just going into that one because it's the cheapest and it's the one that's going to give you the biggest percentage return if you're right. Like
Yeah.
that part of it, I feel is coming heavily down.
That's probably true, especially with the volatility coming down. You're not going to choose such a far out of the money option as you might have in the past, because you're trying to get a cheaper price. I mean, some people just look at it as I can't afford $12, but I can afford $6, and to get $6, I got to go another 10 or 20% out of the money. Okay, that's where I'll place my bet. And I didn't look at the implied volatility before we came in, but I would guess it's down substantially from where it was at 400 handle.
Yeah.
I didn't look to see before we came on. I should have, but I would guess it's probably 200. Got a 200 handle on it now, which is still ridiculously high. But it's like anything else compared to what.
Yeah, and I mean, I current prices, GameStop's certainly overvalued as a company, but as a short squeeze play, I think a lot of people are thinking I can still buy 1 or 2 shares here.
Mm-hmm.
It still might go up from here 5,
Right.
10 fold. That's some pretty big money versus, coming back down another 80%.
Yeah, and it's not an enormous risk. I've been a little surprised that GameStop didn't rush to market to sell some stock. And I don't know if there's a particular reason why. Do they feel that there's sort of an unknown legal risk by selling stock when everything's so hysterical? Were they not set up to do it quick? Do they not have a shelf offering, sitting on the shelf registration for them to do something? So maybe they couldn't do it relatively quick. But this was a chance for them to raise some capital really cheap, and then perhaps sharpen their business model, and make the adjustments they needed to make, for this world where so many people want to do more online. They had an advantage, I thought, which people thought was a disadvantage by having stores. But so many people like to trade in their Xboxes
Right.
and their software and all that other stuff. People like to do that in person. Number two, a big chunk of their business was teenagers. So they drag their parents down into the store and say, that's the one that I want. And so they buy it on the spot. So I didn't see that as big of negative is I think the institutional guys would say, and so many people were just saying, hey, they're going out of business. Nobody buys anything in a store anymore. We'll just buy everything online. And they have a nice online business. And maybe that's where they end up going more heavily, and they don't have whatever it is, 5,500 stores. Maybe the right number is, 2,000 stores, or they just have one or two in every major city or something. But I didn't see that as being such a negative. But if they raise some cheap capital, maybe they can, reformulate their business and come out of this thing, stronger for it.
Yeah, I mean, they always had a fair amount of cash on their balance sheet relative to their size, which is why, like I think Michael Burry was one of the biggest fund managers who was originally getting into shares, when they were in the single digits. It was one of the things that attracted me, like as a value guy, this sort of idea that, a lot of analysts have really overplayed the death of retail companies. And, a lot of people still want to shop in person. You mentioned the used game business model. That's always great. If I, the other thing is just same day. If I, break my controller, I can just go buy a new one same day, keep playing.
Right. I always thought, and this would be free advice to the management of GameStop, so take it for what it's worth, was that, crypto is becoming a bigger and bigger thing.
Yes.
And there's a lot of kind of retail home style mining rigs getting created now, where people might be able to get a half an Ethereum over the course of a year, which is like, that's not a lot, but hey, you got a little toy at home, you're doing your thing, you let it run, you get something worth about $800 at the end of the year. Hopefully it's worth $2,000 a year from now. And I always thought that that could be a retail outlet for a lot of these other kind of machines that are coming out, and that are not too expensive. I'm seeing machines anywhere now from $400 to $800, and that's digestible. If you were a hobbyist in that space, I mean, you can't you can't compete with the industrial players. Of course, you're not going to. They have a warehouse, and they have they've got a 50 megawatt trunk line coming into their place. But I think there's just other things they could do in that electronic space that might work, and it wouldn't take it's a matter of inventory, so it's not, they don't have to make an enormous financial bet to do that, and maybe so. I don't know. I just think there's other things for them to do. The world's all about electronics, and look at what Apple's done with just a store where they sell their computers.
iTunes, yeah.
It's they created an experience where they made it fun to go to an Apple store. I think it's remarkable. Who would have thought? And look at when they first started it. They thought Steve Jobs was nuts. Right? If you remember, they're saying this is the dumbest thing I've ever seen, and his situation was that our product doesn't get any respect in a traditional tech shop, so we're going to make our own, and we're going to make it fun. So I'm optimistic that with some clever thinking they could create something of real value, but they need some capital to do it.
I mean, operationally, I don't see them going away. They've been doing pretty good with e-commerce, not as good as some of the big box stores in the past year with the pandemic, obviously, but that's a unique situation. But yeah, if they issued shares here, let the hedge funds close out, keep the price high enough to keep the retail traders happy, and then just bought Bitcoin or something.
Well, that's right.
They keep the value, and it would probably continue to increase in time.
Yeah, that's sort of an interesting thing. They could have gone with the MicroStrategy maneuver. In their case, they issued a bunch of convertible bonds, like 400 million, 500 million. And then they took the cash and bought Bitcoin with it. Their acquisition of Bitcoin has been spectacular. They started when the share price was about $150. Here they are about 5 months later. 4 months later, maybe, and the stock has got a 500 handle, and has traded with a 600 handle. In fact, it might have a 600 handle now. Um, so yeah, I'm sorry. So I just took a look. It's about $680.
Yeah.
So what a move! What a move! So that caught a lot of people by surprise. But Michael Saylor has been an evangelist on the importance of what he's doing, and building a lot of awareness and education in the public about the importance of Bitcoin. So they could and still could do something interesting.
Right. And I know there are a number of people who point out, hey, if you just took your whole $1,200 stimulus check from last year and put it in Bitcoin, that's suddenly $5-6 grand.
Yep.
It's just had this huge move up, and there's been all this money printing. And I think, that's kind of a big part of it. And the fact that you have these companies that are saying it's going to be a treasury asset. You've got Square and PayPal saying, we're going to keep it on the books. We can be a custodian for you if you want to keep your balance with us in that. Right. There's just, kind of a lot going on in terms of adoption and adaptation, where now you don't have to open up kind of a separate crypto account. If you don't understand how to do a crypto wallet, you're just keeping it there.
Yeah, that's probably a big reason why people are apprehensive. It's like, what's this wallet thing? And, they're used to having a custodian, a bank, take care of their stuff, and not worry about it. So they're the enthusiasts that say, hey, I love the whole fact that a bank is not involved. I can send something, Mark can send something to Andrew and not ask permission for a bank or pay them a fee to make that happen. But it's done wonders for awareness, and we're only going to see more and more companies do something in that space and do more in terms of payment systems. People have been working on, there's tens of thousands of people working on this technology under, the hood ever since the peak of 2017. And people are saying, well, it's dead and so forth. But a lot of people have been working super hard, creating new capabilities. Ethereum's going to come out with they do have it now where you can stake instead of just mining. So that's much more energy efficient. It's one of the things that's going to bring out down the cost of doing transactions on their network. So there's tons of stuff going on, and I think it's going to be like the internet, where we were all playing with American Online, and then one day we wake up and we got a cool browser to work with.
Right.
And it's like, when did that happen? Because it felt like it happened like that to the user, but people were working on that for a long time and working out the kinks. And I kind of think that the same can happen in that space.
Yeah, I mean, the perception can change quickly. I remember in the 90s when the internet came out, it was always, oh, never buy anything online. They'll just steal your identity. Anyone can get in. And now you can just one-click order things on Amazon. Yeah. So not just the technology has improved, but just in terms of kind of our association with kind of how to use it effectively and safely.
Yeah, a lot of technology for safety. It used to be you just had a simple password. Now every time you do something, you log in, and then you get a text message with a number, and you put it in, and all this stuff to for the world to know that you're really the person that owns this asset and is going to move it around, and so that user experience, this a big huge thing. The UX is make it easy, make it easy, make it easy. And that's the whole thing with the app, right? These guys, really work hard on all these apps that have come out in the last few years to make them, super easy. That's what's making Robinhood so easy. You open up your ad, you open up your account. Now you're in, couple of finger taps, and you own 5 shares of GameStop, just like that. Which kind of reminds me, it's one of the things I've written about is it's almost like the gamification of investing. So, investing, getting a little bit more, and that's a little bit of a concern, I think, but um, it's making it so easy. It's sort of like a video game. As long as everybody understands there's real money here, um, and that will help recruit you. That's good. I've heard some great stories. People making a quick buck, paid off their student loans, and I hope that there are more stories like that that come out, and people stay in the investment game. I just hope people that are judicious and careful about what they do, because the idea is and I mention this all the time with my subscribers, is that investing is a marathon. It's not a sprint. The idea is you just keep continuously making a little bit of money through time. It's great. Hey, if you're like one of these guys that wakes up one day and there's 8 figures sitting in your your account, I mean, God bless you for that. Lightning does strike from time to time, but make a number of educated, small bets, and just crunch it and make some money, sort of day in day out, as best you can, and before you know it, compound interest, compound returns. You'll end up with a lot of money in your account, and so I think it's good that people are getting involved with this at younger ages, and they got a break, with their stimulus money. It's like, okay, I got a few chips to play the game, and let's see what I can do with it. And I think that's a good thing. And we know more stimulus is coming because they're talking about it. $1 trillion here, $1 trillion there. Pretty soon we're talking about real money. So, yeah.
Yeah, I mean, that gets into the psychology of investing too. And my kind of understanding from sort of the history of the options market is that it was really designed to reduce risk, not necessarily magnify it. The idea that I'm only paying a fraction to control 100 shares, doesn't mean I can buy 10 contracts instead for the same amount of money. It means I buy one contract and still have 90% cash that would otherwise go into the trade. But I think a lot of traders, even starting traders, they don't necessarily think about the position size, and that can be dangerous.
Yeah, you've got to watch your size, and the idea is you don't want to take a position that's so big that it wipes you out, obviously, but or a position that makes you not sleep at night. So take positions that are a size that well, if you lost it, you would be able to think clearly and decide what to do next. Not do things out of sort of an emotional spasm, as I got to get out, or something like that before I get wiped out. And that was what happened retail in the early days of options. Instead of buying 100 shares, people would go buy 5 or 6 contracts instead. So they had the same exposure, and they put the same amount of dollars at worth, had a much bigger exposure, and so many people would lose all their money very quickly because of that. So options are good. One of the things that I like doing is writing cash covered puts. So if there's a stock I really like and it's trading at $40, and if I really like the stock and would like to own it at $35, maybe I can sell that option for $1. And I put $3,500 aside just in case I get assigned the stock, because I've sold a put. Now, if I bought it at a cheaper price. So presumably, if I liked it at 40, I like it better at 35. And if the option expires worthless, well, I made $1 and I can move on to do a similar thing in another stock. So or play that game over again on the same stock. So there's plenty of nice things that you can do that if you keep your trade sizes managed properly, that you can make nice modest double digit rates of return kind of year in, year out, and that beats what you get at a bank. So, why not?
It beats the bank, but it might not necessarily beat kind of the big fast moving stocks.
Yeah.
And I feel like maybe people feel like they're missing out at this point. Like, oh, I didn't get in at GameStop when it was $5, $10. Still, in the $100 range. That's a big move. That's a life-changing move with the right amount of money. But I feel like investing, it's like waiting for a bus. There's always going to be another bus.
Right. Well, Warren Buffett says it's like a baseball game, but you can't strike out unless you swing and a miss. Because every day a new pitch comes at you, and it could go over the plate, and you don't get called a strike. And you do it again and again and again, and then you get the fat pitch you want, and then you take a swing at it. And patience is a hard thing. And, sometimes investing, the biggest enemy is yourself, because you get what you were saying, the FOMO, the fear of missing out. And so you dive in and do something that maybe you didn't quite think through. It's an emotional decision, not an intellectual decision. And those things happen. So, and the older you get, I can tell you if there's a trading mistake that's been made, I've probably made it. And I hope that I'm smart enough to remember it so that I don't do it again. And that's all part of learning. And one of the things that I've done, especially since I've started writing a lot, is I find sometimes that the investment ideas that I'm most passionate about are not the ones that work out the best. It's almost sometimes the ones that I'm most scared of, or like most nervous about, turn out to be the ones that do better. And I would say it's all of those, with the exception of Bitcoin, because that was like strong about it, but that's not a trade for me. It's like every Friday I buy a little bit, get my paycheck, and I buy just a small bit, and every Friday just buy a little bit, and I don't plan on selling it for a long, long time. So. And so we'll see if it turns out to be the right thing to do. Time will tell.
Right. Yeah. I mean, I think ultimately Bitcoin's it's kind of like right near this tipping point of major acceptance and potential utility to actually be used kind of for transferring, and that purpose as money that was kind of in the original Satoshi paper.
Right.
It's also just, most people have just sort of been buying and holding it. And some people have traded it, and more so because it's a very volatile asset relative to even stocks when they're doing their crazy thing. So
it's nice, though, even if you don't really want to get into the nuance or the geekiness of Bitcoin, you can always buy the Grayscale Bitcoin Trust. You just got to be careful that you don't pay a premium over the net asset value. As a month ago, I think it was trading at a 40% premium to net asset value. So that wasn't a good deal. Right now, it's far more reasonable, because I think the premium is around somewhere between 5 and 8%. I think closed yesterday at 6 and change, or 7 and change, which is modest and might be worth a small premium for the convenience of being able to hold it at your account at Robinhood, Schwab, TD, the traditional Bank of America, Wells Fargo, the traditional, firms.
Right.
So it's nice that there's an alternative. And if you did want to buy a little bit and put it in your IRA account, that's a way to do it without a lot of extra paperwork. And you can do self-directed IRAs, but there's additional paperwork that you got to be sure you get right, because when you don't do it right, then the IRS will correct you.
Right.
And
you want to or not.
And so you got it. So it's a nice way to do things for the average person. That's for sure.
Absolutely. So, I mean, let's talk maybe just strategy a little bit here. Like, let's say I identify a stock that's trading at $50 a share. I think it's got huge potential. How do I know whether to buy shares, buy an at the money call option, buy a far out of the money call option? Like how do you kind of balance those ideas?
All right. So this is I think chapter 6 or 7 of my book, I talk about this. I did a study where I looked at what's the probability of making money, or in the parlance of an academic, where do you get alpha in buying an option? Where do you get a return that's better than the market? And and in that chapter, I show that two things. One is you have a better chance of making money when you buy an option, the longer dated that option is. So your probabilities of making money on a 2-week option is much smaller. The value you're likely to earn versus a 3 or a 6-month option. Number one. So if you're going to buy options, you want to buy options that are longer dated, more time for the trade to work in your direction. The second is you're more likely to do well if you buy an option that is in the money versus at or out of the money. So I start with the following premise. If I am like really excited about a stock and I'm looking for a big move, then I will tend to buy a longer dated option that's a little bit in the money. So the hope is stock goes, and I got 3 to 6 months, for that thing to run, maybe even longer, 9 months, and really get that thing to run. The other thing that I like to do a lot is to sell spreads. So let's say I think the stock is going to move higher, but I'm not looking for an explosive move higher. $50 stock, I think it's probably going to trade to 55, 56. You don't really want to be a buyer of options there. So what I might do is sell a put spread instead. Sell, let's say going out 1 month or 2 months, sell an at the money put, and then buy a further out of the money put to hedge, to cover your risk. Maybe you collect, let's say on an option that had a spread that had $5 wide between them, 50 to 45. Maybe you collect $1.75 for that. So if the stock craters, the worst that you're going to lose is $5 minus $1.75. Okay. But if the stock kind of just inches up a little bit, that spread's going to expire worthless. You're going to keep that $1.75. And then you can look to potentially do that trade again. So when I think about trading options, it's about how big of a move do I think is going to happen, and how much conviction do I have. So if I really think the stock is going to rip, like I thought with GameStop, bought something very long. I bought a very long dated call, slightly out of the money, and then sold a long dated put out of the money. That's like owning the stock, but there's an area in the middle where I just don't make any money or lose any money. So if I was looking for it to take off, I really just wanted to own a long call, but I didn't want to suffer time decay of owning that one call. So that's called a risk reversal. So you think about that as a stock replacement. And then the other thing that you can just do is you can buy a call spread. So let's say you've got a $50 stock, you think it's going to 60, buy a $55 strike call, sell a $60 strike call. You probably pay $1 for that, maybe 75 cents. Trade works in your favor. You cash it in for 5. So you collect 5. You paid 75 cents. You make 475. That's 3 and something times your money. Not a bad day's work. So it's options. Tough part about options, you got to be right about 2 things: direction and time, because options don't last forever, and so you need to work those balance those 2 things. And that's why I think in terms of extent: is it going to move big, and is it going to move soon, or is it going to take a while? And so that's how I think about it.
Yeah, I mean, one of the things that's always fascinated me too with options is you can be right and still lose money. If I
Very
expect the stock to go higher in 3 months and it takes 6 for kind of that move to play out, like my option's already expired and I'm out of
Yeah.
that. So
Yeah, there's nothing more aggravating than buying a 3 month option. It expires, and then that fourth month, that's when it rips, and all that's left on the table. And what typically happens is you're going like, well, I guess I'm wrong. I bought this option and expired. I lost $2 or $3, and I'm not going to go make that mistake again. I'm going to go do something else instead, and then you leave all that money on the table. So
right.
it's the hard part of trading options. That's for sure. So again, that's not one of those things. Trade small, and and be judicious about what you do, because when you are right with an option, the beauty is that you make multiples of what you put at risk. And I think that's what attracts people so much to options, is that I can wager $2 and with the possibility of making 10 or 15 in 3 months' time. So you're making multiples on your money when the underlying stock maybe is moving 20% or something like that. So, um, what some people do is they like to follow where the bid block trades and options are going. Um, there are various services that track that, and I don't know any quote unquote free ones, or you look at it for advertising, but you see a block of options trade. They talk about this on CNBC a lot. Somebody just came in and bought 15,000, Nvidias or Microsofts or something like that, with this strike price. It's telling you something about a big player who's leaving a footprint in the snow on what they're trading. That might not necessarily grab your attention if you saw 15 or 20,000 shares trade in Microsoft stock, but if somebody traded 10,000 calls, well, that's gonna get your attention. And some people use that to help with their timing. And a lot of different styles people have. My style is to try to have an investment theme. Think the stock is cheap, get the valuation right, and then sort of look at the charts and say, is the price moving in my direction? A perfect example of going the other way is for solar. And they're a company that makes a fantastic solar panel, but they flip-flop from losing money one year to making money the next, to losing it the next, to making it the next. So it's like they haven't gotten that place where they're just going to be a cash machine. And so it's a stock that when it pops, I typically like to sell, but it's one that I've completely ignored because it's becoming a bit of a theme, right? The green theme. And the stock has gone in the last year something like from 35 to about 100 bucks. And so it's like, I don't like the valuation. So my knee-jerk reaction is to, well, maybe I'll sell a call spread, which is a bit of a negative bet on the stock. But the stock's going up, and the chart says it's kind of bouncing in a trend channel, and it's just like, I'm not going to touch it. So I kind of look for these two things to come together before I sort of put my money to work and or create an idea that I might write about.
Okay. Well, to piggyback off of what you said, I will say that barchart.com has a tab for unusual options activity where you
they do.
For, hey, 100 of these contracts was the prior open interest. Today, like 5,000 of these traded. It's a 50-fold, rise in volume. That might be worth looking at for finding options trades where you're kind of piggybacking on that.
Well, it might be okay. Maybe somebody else is thinking my way. So if I have an idea and the stars start to align with the way I do things, that's going to be the next place I go check then to see if somebody else is either there beating me to the punch and stuff. I tend to have, when I trade options, um, most of the time, let's call it 70% of the time, a horizon of 1 or 2 months of something happening. Um, and the other 30%, I'm kind of looking for a good um, secular, kind of secular move. And something that might go for 9 months to, let's say, a year or two. Then I'll buy some longer dated options for those kind of things. Um, but options by their nature are short term, and so, as I mentioned, you got to get the timing right. So you got to be careful. You got to be patient. Go like the I want to buy this stock. It's slowly coming down. Pfizer's a perfect example of a stock that I've been wanting to buy. They have. It appears that their vaccine is pretty good. I'm not an expert in that space, so but everything I kind of keep seeing. But the stock kind of like ratcheting, kind of chopping lower, chopping lower. And then I heard on CNBC today about they talked about the stock, and it's going to be a big revenue number, for them and the other people doing stuff in that space. Although it's my understanding most of them are not charging a price that would result in a significant profit. Um, and so I'm not sure what to make of it, but it's a company I like. They got a lot of great products, and the stock, and it's relatively inexpensive, but it just keeps going down. So you got to just stand aside and be patient and kind of wait for a turn, and don't jump in too fast is my thing. It's just wait till the stars get aligned, and like you said, you don't have to trade every day. And if you miss a trade, there's going to be another trade tomorrow and the day after that. So that's sort of my approach.
Right. Well, let's just say, like, how would I identify the next GameStop? Would I be looking at that unusual option activity? Would I be, following internet message boards? What's the best way to, kind of just set yourself up so that you can be in one of these positions, not with all your money like some people are, but with a tiny bit. So if it does go up tenfold or 20-fold or 100-fold, you suddenly made some real money.
Right. So to my way of thinking, if you're trying to find that stock before the crowd kind of gets on it and the Robinhood crowd jumps in, look at a list of small cap stocks, medium cap maybe was okay too, and look at their short interest. And maybe you want to sort by short interest and focus on those that have a short interest of maybe 30-35% and higher. Um, and then um, and then look to see if what the valuation looks like. If they're cheap, you might want to jump in and do it. If there's already a bit of an undertow and the stock's moving up, maybe you just want to jump in because that process has started of other people starting to accumulate a stock that's heavily shorted. Um, the heavily shorted stocks have tended to perform well in aggregate, and so you're probably not taking too much um, risk by picking those up. Um, from time to time, the hedge fund's going to be right, though. They're going to find something that is not good, not right, and it'll be $40 a share, and it is going to $5 or $10.
Right.
And I tend to, in a lot of things that I think that watch for short sellers that are like bashing the company. That is somebody that's probably going to get caught in a short squeeze. And the reason why I say that is I tend to think of these things not so much as I want to short a stock because it's a terrible company or terrible business model or terrible management. To my way of thinking, most of the time it's that, this is just a stock that's gotten ahead of itself. It's a $50 stock trading at $90. And that's a useful stock to to short. The shorts are playing a useful role in the market there, where they hopefully bring or presumably bringing the share price down back to 50 or 60 bucks where it belongs. But I think the guys that are out there advertising, what they did, sort of like what Bill Ackman did with Herbalife. He kind of announces, "Hey, I got a billion something size short here," and that was just too much for Carl Icahn to resist.
Right.
It just said, he laid himself out there, and so. And there are games the longs can play. They can go in, they could buy a bunch of stock, and then they could move it into a cash account, and then that stock can't be lent out. Only stocks that are sitting in a margin account can be lent out. And so that's a thought for your customers. All your customers that are watching the show and brokerage guys that are buying GameStop. They have margin accounts, and the firms that they deal with make money by lending their stock out. So if you're not going to trade on margin, then have a cash account and buy your stock there, and then nobody can borrow your stock and sell it short against you. Is a thought that might be worth doing, but I think most of the people out there want that extra leverage right now.
Yeah, but it does also seem like we've really exposed in the past few weeks just sort of how the hedge funds have been able to build these short positions to the point where individually they might not have been thinking about the market as a whole, but then you suddenly realize, hey, there's more than 100% of shares being held short.
Mm-hmm.
It doesn't take that much at that point just to get enough people buying shares to really kind of spark some fear and add in the gamma squeeze for people who didn't want to buy shares.
Yeah.
And it seems like we're going to be dealing with this for a while. Do you see any potential regulatory changes or any brokerage changes that might come out of the GameStop situation?
I don't, because the only thing that's unusual about this situation is it's not two institutions fighting with each other. It's it's retail fighting with the institutions, and I don't think it's pretty hard for, I think, a regulator to come out to say that they're doing this to protect the retail, and whatever they do would be to protect the retail investor, right? That's going to be a tough argument to make, and I kind of, if I sort of game theory this one out and think about, well, what might they do? I can't think of a regulation that would make sense. You can only trade 100 shares at a time. To me, stopping trading is the worst thing you can do. And people, you got to let the market work. That's people buying and selling, making their free choices, and brokers do now. The one way they kind of throttle this is with margin requirements. They just did this in the futures pits in silver. I think it was today or yesterday. They increased the margins by 18% on futures contracts. So if everything starts to get a little crazy, they just say you can play the game, but instead of putting 50% down, maybe you need 60% down, to buy your stock, something like that. That mechanism is already in place today. The Fed does these regulations through Reg T, and they set the bare minimum. But any broker can decide it should be a little bit higher, or the exchange can say it needs to be a little bit higher. That's the only thing that I could see that maybe the SROs, these are self-regulating organizations. There's a lot of them in the finance business, that they will adjust that, but that whole mechanism is already in place. So I don't see something come out, and I would, and I certainly hope not. I don't know what they could do to quote unquote make things better. I can imagine them doing a lot of things to making it worse. Um, and so I hope for the best.
Yeah, I mean, that reminds me during the housing crash, the SEC came out and said, okay, we're banning short selling on these financial names. So people got worried and they went out and they sold their financial stocks, which had
Right.
already been going down, and it made it worse. So
Right.
it
Yeah.
does seem like anything the government does needs to be with a light touch, and it needs to recognize that, yeah, you might be ticking off your donor class, but all these people who vote for you, they've got a seat at the table here, and they can clearly now coordinate and kind of organize things in a way that they've never really been able to do before. And they're a player too, and they need to be treated with respect.
I agree with that. And people will get smarter over time. See, one of the things that is bad about overregulation is people don't really sort of explore the edges when things are overregulated. And that's where you learn. You do something, you get stung, and then you know what not to do. You get smarter. As you know, that's the way we learn as kids, right? We do all kinds of stupid stuff, and we know not to jump our bike off, a 10-foot curb because we might crash, unless you're really good, of course. But we all learn by mistakes. It's the way humans learn, and so if you're free to kind of do what you're going to do, and you figure out what works and what doesn't work, you just get smarter over time.
Right.
And so I'm not one to argue for no regulation, but I always kind of feel like there's too much, and so less is often better, in my view. So I hope there's not any new regulation coming down the pike, and it might just mean that everybody in the whole process has to have a little bit more capital, which would be fine.
Yeah, that would avoid much more extreme market crashes when that's more likely. So
Yeah,
adding more stability to the system is never a bad idea, I think. But
yeah,
it just means you can't make
more capital does that. It's a lot of what's around bank regulation. Most banks, Lehman Brothers was levered 35-1 before they went under. Would they have had such a problem if they were levered 12-1 or 10-1? Probably not. They'd probably still be here today. They would have been able to, work through the financial crisis. So capital, having a little excess capital around is always a good thing, to protect you from the unknown unknowns that can pop up from time to time.
Great points. All right, we're coming up on the top of the hour. Your website is theoptionsedge.com. Is there anywhere else where people can learn more about you and your work and kind of see what you've been writing about?
Oh, you can go there, and see the stocks that we've been done. We post up a list of all the trades that are closed. The subscribing members get to see what's open. But I tweet at mguthner all the time.
Okay.
At MGUTHNER, and I pop up ideas all the time, or a chart showing, hey, this is kind of unusual. Keep this in mind. I do that all the time. We do some of these also at the Options Edge. It's the and underscore Options Edge. It's what we could get on Twitter. Those are the places where I just kind of toss out ideas all the time, and hopefully get a little bit of a conversation going. I haven't been active on Reddit, but I'm kind of thinking about that might be a fun thing to do going forward. So that maybe you'll find me floating around there at some point.
I recommend it. You'll see a lot of people just being really happy posting their 50, 75% losses in GameStop and just sort of having a very different kind of reaction than a hedge fund was last week, who was short the company. So it's an interesting and dynamic group, and kind of all sorts of ideas out there, from hedge fund level due diligence to just random posts and memes. So
yeah,
not too bad.
I think it's great. And my students, They really enjoy it. As we start every class with 10 to 15 minutes of discussion around what's happening in the markets, and I encourage them to, hey, I saw this. What the heck is going on? Or how can I make a buck in this, and stuff like that. So we talk about what's going on in markets because I want to bring what's happening in real life and match it up with what they say happens in theory and in the textbooks and stuff, which, a lot of the textbook stuff is right. The textbook stuff on valuation is really tough on what I like to call exponential stocks. Those are these things that are small that if they work, they're just going to really go. It's
the new technologies. Yeah.
Yes. And the traditional valuation methods are not particularly useful, for that space. At least I haven't found a way to make it useful.
Right.
So we talk about all these things, and it makes for a challenge. And the students do ask for my opinion on certain things. Like they asked about, shouldn't there be somebody that says when things get crazy, he turns off the switch? And I go like, well, who are you going to trust with the switch? That might be a decent idea, but who is the guy that's going to be so smart to know when you do that? And I said, how about Tesla? You could have gone back 6 months in Tesla because Tesla is doing this, and then it goes like this. Who's going to be the guy that turns off Tesla? We might have opinions on valuation stuff, but that's what, the thousands, if not millions of people that are trading are making that decision. So, we talk about everything from individual stocks to the cryptocurrencies, to how we might go about valuing something. Some of them are starting to take a liking to technical analysis, which is, a problem when you're in the house of the efficient market hypothesis.
Right.
But I teach them that anyway because, I've been a practitioner of Elliott Wave for, I don't know, 30 years or something. And I love trend channels. So, don't fight the tape. If the trend is from the lower left to the upper right, then you got to think about being long, and don't try to make things more complicated than they necessarily have to be. So that's good stuff.
Very good. All right. Appreciate your insights. Thanks for joining us today. And for everyone here in Wall Street Reporter, thanks for your thoughts on these unprecedented times and the true power of the retail markets. I think it kind of goes to show between this and Bitcoin that, the future, it's going to be decentralized and it's going to work. Yes. And, it's just going to be a learning process along the way till then.
It is.
So until next time, Andrew Packer signing off.
Thank you, Andrew.